Greetings to investors in the capital market. I am Kotte Murli Krishna, a chartered accountant by qualification, and the founder and CEO of EVU Financial Analyzers Private Limited, aka Eagle Eye View, a SEBI-registered firm. Skipping all the chit-chat for later, here's my question to all the investors in the capital market. Is your investment in the equity of listed companies safe or at risk? Let me take you through a scenario for a better understanding of this question. 1. The Indian soldiers are protecting our nation and its sovereignty, and providing safety to the Indians at the cost of their lives. 2. The scientists are continuously involved in saving the precious lives of the Indians from viruses like corona at the cost of their lives. And so on. But coming to capital markets, the same system is not very strong. The practice of diverting funds for their own benefit instead of the actual use by willful defaulters for multiple decades poses a significant threat to investors in the capital market, banks' net worth, public hard-earned money, and the Indian economy just because of lack of preventive measures in the system. Well then, what is the remedy and how can one play safe in capital markets from further funds diversion by willful defaulters is what we are going to discuss today. Now coming back to my question, you might be asking what risks we are talking about here and why is there any need to check the safety of the investment. That's where we come in. Welcome to Eagle Eye View. Among all the risks out there are three common risks. 1. Default risk. It is the risk that a company or individual will be unable to meet its contractual obligations. 2. Liquidity risk. This is the risk of not being able to divest of your investments to get cash in hand quickly. 3. Financial irregularity, an intentional misstatement or omission of information related to financial transactions. Now I am not going to bore you with all the risks out there, but if you want to learn more about these risks, we have provided you with a link in the description. Any risk whatsoever implies that there is some chance that the money invested may not grow or can decline in value or to the extent that you may lose all the money invested. The point here is that whatever the risk may be in the investment, the important risk above all the risks is losing all the money invested in any security or asset. Let us now study what causes the listed companies to become sick, bankrupt, and be referred for liquidation. I should tell you, starting from Harshad Mehta and Ketan Parekh capital market scams, and as far as my knowledge is concerned, the banking industry must have written off about rupees 40 to 50 lakhs of crores of NPAs just because of funds diversion by willful defaulters. When JPC was constituted to submit a report on the Ketan Parekh capital market scam, the then RBI governor admitted before the committee stating that the present system is ineffective in preventing the practice of funds diversion. The ineffectiveness in preventing the practice of funds diversion has been continuing for multiple decades. That is the reason why the number of listed companies being referred for liquidation has been increasing from day to day. Now, what is funds diversion? When we want to set up a unit, we can have two types of funding from the banks. One is a term loan to meet the project cost, and the other one is a working capital loan for regular operations. The bank sanctions the working capital loans, stipulating a condition that these funds must be used for the purpose for which the limits are sanctioned and should not be used for any other purpose. The management of the company, say, out of their greediness or with mala fide intention or to satisfy their wicked desire, diverts these funds for other purposes like investment in subsidiaries, capital market, or for expansion modernization of existing units, or for purchase of long-term assets that would seriously impact the regular operations of the company, and over 2 to 3 years, the company would become willful defaulter, bankrupted, and will be referred for liquidation. Who are the major losers in this context? The banks and the investors are the major losers when the bankrupted companies are referred for liquidation. At least, the banks will be on the safe side to the extent of the realizable value of mortgaged assets. The shareholders of the company would not get even a single rupee of the face value of the shares and forget about the investment they have made at market price. Let us see the scenarios of some of the cases of defaulted listed companies referred for liquidation or under BSE surveillance as per IBC. 60 listed companies disclosed debt defaults of 75,000 crore rupees. 49 listed companies disclosed debt defaults worth 69,140 crore rupees. This is the list of those 8 listed companies which defaulted as shown on the screen. At $50.93 billion, the defaults are a hefty sum, amounting to roughly 4.22 lakh crore rupees. This is comparable to the annual budgets of two Indian states, showcasing the significant financial impact. There are a minimum of 88 listed companies referred for liquidation as per NSE, which you can check from the link in the description. There are 145 companies under BSE surveillance for additional measures. I have provided a link for this list as well in the description. Coming to the point, we can strongly believe that these borrowers of listed companies are only a small part of a huge loop. So, how do these sick or defaulted companies lose investors' wealth? One of the answers lies in the concept of funds diversion. The main motive of the company is running their business as usual and growing with the help of funds borrowed. But these companies intuitively use the funds wrongly, which weakens the business of the company and ultimately loses shareholders' wealth. Viewing this from another angle, the investors did not invest in the companies which defaulted, but they have paid the cost of the wicked desire of willful defaulters. The two words funds diversion are dangerous to the Indian economy. The rising funds diversion by willful defaulters scenarios poses a significant threat to investors in capital market, banks' net worth, public hard-earned money and Indian economy, necessitating preventive measures. While the willful defaulters are encashing the weaknesses in the system, common people have been paying the cost of lapses in the system. So, how long should the investors in the capital market burn their hands? Should there be an end to this persistent practice of funds diversion by willful defaulters? Preventive measures, an initiative by Eagle Eye View to safeguard the investors. The only preventive measure to protect the investors from the defaulted companies is to make them aware of the companies by analyzing the financials of listed companies, the financial health status, financial irregularities, performance for the year, market value, and the growth indicators with professional observations to bring it on to the notice of the investors to empower them whether investment in these listed companies is safe or at risk. Let us take a case study and understand what the Eagle Eye View can provide you from the company's annual reports and help you to decide better whether the investment in the listed company will be worth it. Here we go. This is just an example we are taking to help you understand the process. The spreadsheet shown on the screen can be interpreted by any investor. The main objective of interpreting this sheet is to check whether the company is good, bad, or even moderate compared to the benchmark in terms of A. Health analysis, B. Financial irregularities, C. Profitability, D. Market value, E. Growth indicators. If we take an example of, say, health analysis, we can find that the debt-to-equity ratio under the solvency ratios head for this company is 0.84, which is quite good comparing the benchmark value, which is between 0 and 2. Based on this value, the indicator is set to positive for this factor, and the observation is it is good and not risky. Likewise, we can observe the company's financial status by considering other factors. Going through the indicators and observations column of the spreadsheet can help us understand the financial status of the company. If the indicator is given positive and observations convey a positive message, the company seems to be good, but it cannot be further decided until all the observations are considered. You can also check the financial status and performance of the company from the given pie chart at the bottom, which is just a summary representative of all the indicators of the financial aspects of the company. The more percentage and area of the positive side, the better it is. It is advised to be cautious if the company's financial health condition is not good and financial irregularities are reported in the analysis report. To check the financial health of other companies, you can download our mobile application Eagle Eye View, which is available in both Google Play Store and Apple App Store. Download and install the app and sign up quickly to view the desired reports. That's it for today. If you want to know the exact process of screening the stocks, you can subscribe to our YouTube channel where we keep posting such content. Comment down below if you have any questions. See you in the next video. Eagle Eye View, unlocking insights, maximizing wealth, shaping tomorrow.